Well, welcome everyone to today's webinar. And as folks join up, with it being 4 o'clock, we're going to give everybody just a few minutes here to get situated on the call. Thank you for joining us today. My name is Greg Patterson, and I am joined with my teammates, J.A. Kennedy, Tara Gould, and our newest teammate, Jen Mann. Jen is here in our Morehead City office. And if you're a client and on this call today, you should have gotten an email communication from us, just introducing her to you. And we're excited to have her on board. She is serving as our relationship manager and will be part of these calls as we provide them to you each quarter. The last time we were with you, it was July. Here it is, October. Wow, that was a quick quarter that went by. And we have, we're on the doorstep of a presidential election, a lot of economic data to talk through. So this is our opportunity to share with you in a bite-sized format about some key data. And so this just shares our thoughts on where we're headed, but we also wanted to bring some important information to you today. And so we have a guest speaker with us, Marilyn Whitley. Marilyn is here in the Morehead City area. She lives on the Crystal Coast with her husband, and she is actively helping our clients in her business as a healthcare expert. And so I thought it would be helpful to bring her on board and just share some comments briefly at the beginning of this webinar. Her company is Whitley Patient Advocates, and she has a background skill set in nursing, but also clinically as an administrator, and now as a small business owner, helping our clients. Generally, they're elderly, but not necessarily the case, but she's been really instrumental in helping our clients with putting a healthcare plan in place and serving as a very high quality and high service, the same as we do, point of contact for our clients with their healthcare issues. So we'll introduce her in just a minute. And with that, let me just run through our other items that we'll discuss today. We wanted to talk through current market returns. It's been a great year, so Tara's going to go over that with us. We're going to talk through latest economic data, and Jay is going to bring you those points. And then we're going to share some about the election and the market. We have an inside scoop on what's going to happen on election day, so we'll bring that to you. And we're going to talk through a financial planning topic today. We're going to give you a little bit about Social Security and the updates. And then we're going to give you our conclusions. And so we should be done with the call here, hopefully in 45 minutes. It'll be a good use of your time. So with that, let's get started. Marilyn, I'm delighted to have you on the call today. Thank you for being here with us. And we said in the beginning, we want this to be a conversation just about your business and how our clients benefit from you. But I thought we'd start out just with a question of, tell us about your core business and who your ideal client is.
Well, thank you, Greg. It's and everybody. It's a pleasure to be here. My husband and I started this business. It's been 5.5 years ago now. And after working in healthcare, I've been doing this now for almost 30 years. What was really evident year after year was the confusion in healthcare, right? And how people got overwhelmed. And then working in the corporate area, it was very hard a lot of times for us to be able to offer advice or, point people in a different direction because we were restrained and, restricted by the policies and procedures in the places that we worked. So that was a big push, identifying how do these people get help. And then the second push that came was our, aging parents. We both had both of our parents alive, mine living out of the country, David's living near, both with health issues. And then as a child, an adult child with children of our own and jobs that are very busy of our own, how do we navigate and help them? And then lastly, the other piece was, how do people who are not in healthcare understand any of this? Because it was so just overwhelming for myself a lot of times, because a lot of times in healthcare, you get very narrow in your scope. So then being able to look at the big picture. So I think that was the three biggest things that kind of pushed us to think outside the box, and then look at patient advocacy. And there was a board certification, and it was a new growing profession. And of course, we had seniors were, dear to our heart, both of us in the profession of healthcare, plus with our aging parents. So we wanted it to represent a lot of the seniors so that they would have access. But really, it's for anybody that has healthcare issues in the system, that has navigation issues. But ideally, our clients are seniors and the adult children of the seniors.
Yeah, and you've really been an answered prayer to us among our own clients, but also personally with family members, and have come along beside them to really provide a high touch, very personalized, hands-on approach to navigating healthcare. And in many cases, it's for clients who could have diminished capacity, right? And so we've seen the scope of your work. Can you talk a little bit with our viewers about the different services that you provide?
Sure, that's a great question. So I just want to say, like, our overall goal, the value that we try to bring with our services is that we always want to maintain independence in our client. And the goal is for them to live where they want to live. So a lot of times it's giving those folks, the seniors, the independence to stay at home, and then being able to transition from one area to another. And that being the goal, always in there, is that they maintain that independence and feel like that's a good start. So I think a lot of times that's what you guys see in your clientele, is that, we want to get in and do that assessment and see, can they stay at home? Can they stay in control of their life as it is right now? Or do we need to transition or add pieces to keep them there? And then we're the outside unbiased person that's coming in, the non-judgmental, or that's what sometimes folks feel like, we bring no judgment in there, but it's to look at the situation and from a safety and a health perspective. Can this individual stay there? So a lot of times, if I was to summarize our services, it is that navigation, but you'll see a lot of what we do locally, especially on the coast here, is that we help a lot of folks maintain their independence, that being staying at home, and then adding those transition pieces to be able to move to the next step as they age, but do it as seamlessly and flawlessly and independently as possible. So if they're at home, it would be, do they need to add a few services like, grocery delivery or a maid service or home care or some transportation, those kind of things. And then when they reach the peak where they've maxed out on that, is it time to transition to assisted living? And then of course, from there to long-term care and that kind of thing. So we offer a lot of services, but I would say a lot of the times, what you see is, if I was to summarize, is in those transitions of care, and I say that's a very healthcare term, but it's basically when life changes and you have to think about moving from one stage of life to the next. And our goal is always to try to maintain that independence to stay there. Our services are broad, like, on the individual basis, but I think that kind of adds to the bigger picture. Greg, I know we've helped you some. Does that sound kind of like what we do in a short?
It does. I think the thing that we've taken away from your help is that it's very customized. So you get to know, just like us, you get to know the client, and you put a healthcare plan in place. We put a financial plan in place, but it's I would say we put a fiduciary hat on. You do that the same way in the healthcare space, and so yeah, I think
Yeah.
it's very valuable. And in fact, our aging community, most of our clients, I guess the biggest demographic for us is clients over 65. And so that aging demographic here in Carteret County lends itself to the work that you do.
Right. And we like to get in early, preventative is always the way, get us on board, and then we can help transition, or prevent those, quick transitions, maybe make it more gradual, add services that they can do. And then, I would just say, if it was to help in the explanation of how we are perceived and how we, a lot of times I'm thought of as the other daughter, like I'm here, boots on the ground. Children may live at a state, but when I'm here, I become that person. So, what is it that you need? And a lot of times in our one-on-one meetings, that's why I said, just tell me what it is. It doesn't matter. Of course, I know Judge Zone. So, is it that you feel like you need help with dressing? Do you feel like you need help with your bills? Do you feel like you need help with your medications? And then, getting down to the root, honestly, of where those deficits are, and I say it's deficits because it is in that they are a lot of times are owned, and those little pieces sometimes become what people think are little become very difficult to them. So then I can just, quickly step in, kind of set up a plan of action for them, give them back their control, and then things seem to run much smoother in that sense. So
What would you say is the biggest advice you could give someone who's viewing this? Maybe they're a son or a daughter of an aging parent who's trying to navigate the complexity of the healthcare, whether they live here in Carteret County or away from their parents. What's some
right.
advice you could give them today?
I think the biggest thing is trying to look at the overall picture of everything, which I know can be very difficult, but having that, a lot of times I talk about when I do little in services with folks or that kind of thing is, everybody needs an advocate, whether it be a child, a spouse, a paid, independent patient advocate, but someone that can look at the big picture and put things together for you. So then as you do age, you're able to transition into each, level and do it smoothly. So I think the biggest thing is having that big picture together, the legal part, having your POAs together, and then your financial part is so very important, and be able to forecast when you have certain chronic diseases, what you can expect from a money perspective, how much you're going to spend, or when you could think about you may need additional services. And then having someone that can find those services, of course, so having a coordinator and but I think which is very difficult again, because it's navigating all of the systems, but having the big picture. And sometimes, as an adult child, your parents don't really want you to be in their business because they feel like they're already a burden because they're, at a certain age, but it's, figuring out that way to get in there, doing it, um, as nicely as you can, or and if you don't have that relationship with a parent, then maybe suggesting like someone like us, like an independent patient advocate, or, or doing it like often, like I've done with other financial advisors. It's the financial advisor that reaches out to us and brings us in. And then that trust is kind of already there and we're able to, and a lot of times we're not needed for long haul. It's just in those transitions or to kind of get someone started to make sure, "Ooh, okay, I got everything. All right, I got everybody covered and I'm good." And then you just kind of, cycle through and do that. So
I think a great term to describe your role would be a quarterback of the healthcare system and navigating that for someone who is needing more of those services.
correct. And we often, one thing I will just say, like, this time of year is of course insurance sign up, right? So everybody is like, "Oh, do I have the right insurance?" Open enrollment's coming. Now I got Medicare, so we offer that as well to folks where we can kind of look at their insurance. And like I just um signed a new client recently and we went through all their insurance and she was like, "Oh," and I was like, "You have great insurance. You're a federal employee, what you have, just forget about all these Medicare Advantage people come to you, you've been well taken care of." And she's like, "So I can just throw all this other mail?" I said, "Just but it's that sense of security and those pieces that, they don't quite understand. And if someone could just tell them, yes, you've got good insurance. Yes, you've got a good primary care. Yes, you've got, a great plan in place. You've got all your legal paperwork done. We know what your wishes are, those things. It's very reassuring to someone who is
Oh,
aging
I'm sure.
and wants
Yeah,
to be independent, very. And the adult children too, because you want mom and dad to be as independent as possible and live their life as best they can without overstepping. But as they age, you still want to be supportive and you want to love on them hard and you want to make sure they're well supported. But there's that fine line that ends up being can be crossed really easily. So as a child, it just, we understand that it gets very difficult sometimes to do that. So
well, thank you for what you do and
Awesome.
for making a few minutes to be present with us
Absolutely.
today. If
Yeah.
you're a viewer today and you want to know how to get in touch with Marilyn, the information is up on your screen. info@whitleyptadvocates.com is her email. Also, her phone number is there. If she can be of service to you or help to you in your situation, or anyone you know for that matter, feel free to reach out to her and start that conversation.
And we still offer free conversations. I'm hoping that we'll always be able to offer, it's just being able to listen to someone for 10, 15 minutes to be able to, and sometimes we're able to offer that. So we always tell folks, just remember that even if you feel like you don't have the money to be able to pay for a long-term service agreement with it or however, but we may be able to point you in the right direction to get help. And that is always our goal.
Perfect.
So,
Well, thanks again for being with us, and
Thank you,
I look forward to
Marilyn.
catching up with you in the future.
All right. Sounds
All
great.
right.
Thank you.
Thanks,
Thank
Marilyn.
you.
I know she has been really instrumental in our clients' lives, the several that have used her, and as a consultant to be able to walk folks through that process. So just glad to have her on the call. Glad to know she's a resource in the community, and good stuff. So let's kick it off. Tara, you are up to talk through market returns year to date. It's been a terrific year, hadn't it been?
I agree. It's always fun to have this topic when markets are doing really, really well. So the first one we're going to start with is S&P 500. Just a reminder that indexes are unmanaged. So we're not investing directly into the indexes, but we can invest in mutual funds, ETFs that mirror these indexes. So the first one is S&P 500. It is still regarded as the best single gauge of the overall US equities market, leading 500 companies in the United States. And so this is large cap, so thinking large companies here, significant portion of the total market. That's why we say it's the best gauge. But let's take a look at January. So January, the index kicked off the year at slightly over 4,700. When we met back in July at our last webinar, I gave information about the index was around 5,500, and now we are over 5,800. And so from a year-to-date increase, that's an increase of over 23%. And you can see in this chart, we've had some dips along the way, but the trajectory is upward. The one-year look is also exciting to see. So first thing you're going to notice is those dips that looked a little bit deeper, they're smoothed out a little bit more. And this happens the longer time frame that we look at from a market perspective. So in October of last year, the index was around 4,500. And as I mentioned before, we were looking in July at 5,800. And so now you can see, I'm sorry, 5,500. So now you can see we're at 5,800. So that puts us at the 12-month increase of over 38, almost 39%. Next, we have the Russell 2000 index. And so we were looking at large companies with S&P 500. Now we want to look at smaller companies, so mid-sized to small companies. And just to note, the index year to date is up over 230 points. We started the year at a little over 2,000, and now we're currently trading over 2240. I didn't see what the market closed at, but it was pretty close to this. So this is an increase year to date of over 11%. And taking a step back, looking at the movement over the course of a year, October 2023, the index was obviously a little bit lower. So in that a little above 1600 range, and today we're at 2240. So that puts us at an increase over the 12 months of 34%. Amazing.
Nice.
And then last up on the market updates, we want to look at the NASDAQ. This is again another staple of the financial markets. 3,700 companies, heavily weighted towards technology. Actually, more than half of the companies are considered tech companies. January 2nd was our first trading day of the year. The index was just under 15,000. And currently, as you can see, we're over 18,000, 18,500. So that puts us at a year-to-date increase of over 25%. And then that broader time frame in the 1 year, in October 2023, the index was at 13,000. We fast forward to today, we have an increase of over 42%. So just within this time frame of 12 months, we've seen an increase of over 5,000 points.
Are these our new baseline figures for the next upcoming year?
We'll see. Hope so.
All right, so next we want to shift our focus to an economic indicator we pay close attention to here, the Consumer Price Index, or CPI. As many of you already know, the Consumer Price Index is published monthly by the U.S. Bureau of Labor Statistics, and it measures the rate of change of U.S. inflation over time. So put another way, it measures the cost of living for the average person. So when we refer to the percentage change in CPI over a period of time, that's when we're referring to the inflation rate. Obviously, the CPI is a big area of focus for both the Federal Reserve and the overall markets, and it really gives us a good look at how the economy is tracking from a big picture standpoint. So the first slide here, it tells us that the CPI increased 0.2% during the month of September on a seasonally adjusted basis, which was the same increase we saw in both July and August. This was slightly higher than the consensus expected 0.1%, but we would prefer to see this figure down from some of the monthly percentage changes we saw earlier in the year, such as 0.4% back in February and March, as this represents a gradual slowing down of inflation. The second slide that we're going to shift to, that shows us two things. First, if we look at the bottom, or the blue line, we can see the annual inflation rate is 2.4% year over year. So to put it another way, it shows us that the cost of goods and services has increased by an average of 2.4% from September 23 to September 24. So this is higher than the consensus estimate of 2.3%, but it's lower than the 2.5% we saw in August. So the blue line also includes all goods and services, but the chart also shows us a red line, which is what we call core CPI, and that excludes energy and food prices. So just taking a quick glance at the two, you can see the blue line has some more significant ups and downs over the last 12 months, which is due to the fact that there can be greater volatility in food and energy prices, which can be unpredictable and quite frequently can have little to do with actual consumer demand. So we see a slight increase in the red line, again, which is the core CPI figure. That's a reminder that inflation hasn't tapered off completely, but we do believe that based on what we're seeing, the Fed will continue to cut their key rate at a slow and steady pace, most likely by a quarter point going forward, with the goal of bringing inflation down to the roughly 2% target. So we always like to remember when we see CPI trending downward, as Greg and JA and Tara have mentioned in previous webinars, it's not necessarily indicative of prices going backward, but rather just a slowing of the increase in prices.
Good reminder, Jen. Thank
Yeah.
you.
Good point.
All of this talk about CPI, inflation, brings us to the cartoon of the day, which I think we all can relate to. In this cartoon here, the Fed chair is sitting on top of a pile of what is to be receipts, and he says, "Woo, a soft landing. Let's do a half point rate cut." And the consumer there at the bottom of the pile says, "You're lucky you landed on all of our grocery bills." So as Jen stated, yes, inflation has come down, way down from where it was tracking at 9% if we look back at the height. But it doesn't mean prices are lower. It just means they're increasing at a slower pace, which is a good thing. Now for just other economic data, which is kind of a mixed bag as we look through these bullet points of items. Just looking at employment, unemployment, initial jobless claims. Unemployment has ticked down just slightly over the last couple of months. We were at 4.3%, now 4.1%. Initial jobless claims have maintained at a fairly healthy pace, up a little bit over the last couple of weeks, but not an alarming trend. The housing market has been really what it's been for quite some time now with the higher interest rate environment. Existing home sales are down year over year. New home sales are up. So less people selling their existing homes at low mortgage rates. Interestingly enough, new home sales are up about 10% year over year. So that's really where the growth in the housing market has been. Retail sales are up from a year ago, but not drastically. So less than 2%. If we look at this time last year, an increase of about 2%. Industrial production has been kind of a weak area if we look over the last few months. So we'll maintain watch over that. And then gross domestic product, GDP, just an overall measurement of the economy, health of the economy, growth, production of the economy. If we look back, the first quarter of this year was 1.6% annualized. Second quarter was much better at 3% annualized. And then next week, we'll get the third quarter first estimate of third quarter GDP. And the range expectations of that are in the 3 to 3.5% range on an annualized basis. So that is a very healthy rate of growth. So from just looking at GDP, if we end up in that range, that's a good indication of just, I think, and a testament to the resilience of the economy as we've had higher interest rates.
Mm-hmm.
And then the last bullet point there, the Fed, Jen already mentioned just expectations on quarter point decreases. We had the 50 basis point cut in September. Going forward for November and December, expectations are that we would see 25 basis points probably in each of those next couple meetings, and maybe even continuing into the first of the year. But we will maintain watch over all of these things as we move forward in the coming months.
Seems to be pretty orderly, though, the way the Fed approaches this. So there was 11 rate hikes, and now it's been telegraphed fairly well about the rate cuts.
Yeah,
They've been driven, I guess, is what they say.
It was somewhat unexpected to get the 50 basis point cut to start things off. Hopefully we'll look back at that and say that was a smart decision just to get the ball started on the rate cuts. Mm-hmm. We are almost a couple weeks out from Election Day, so we would be remiss not to include an election slide in our presentation today. This one in particular just goes back to 1972. It looks at presidential election years and the stock market measured by the S&P 500 3 months before the election and 3 months after. So this is encouraging to take a look at data like this. We can see 3 months before Election Day, the average gain has been 1.5% for that 3 month period. And if we look 3 months after the average gain has been 5%. So elections, if nothing else, they take uncertainty out of the market, and the market likes certainty versus uncertainty. So no guarantee that we'll see this hold true this time around, but if we look back since 1972, the only times things have been negative in the 3 months after the elections have been where we've already had underlying issues, like the dot-com bubble in 2000, and then the real estate bubble bursting in 2008. So those are all encouraging things as we think about the election coming up. We can get focused on a lot of different things, but focusing on the market crashing, I don't think is what we're projecting or predicting.
Good point. And that leads us to talk through time-tested investment principles. There can be all kinds of news and discussion around an election year as it relates to your money and what should you do. And so with a rise and run up in the market, as Tara has shown us, most of us are feeling pretty good if we own stocks or, any type of growth asset, even real estate. But you can sometimes get led astray by some of this news that's out there. And what I've found, and Tara, Jen, and J.A. probably can echo this, is that sometimes the news gets very, very interesting. That we should do things like put all of our assets in precious metals, or, that there's going to be some new law that would change the way that capital gains are taxed, or even unrealized capital gains for that matter. So, what we try to do for you as your trusted advisor is bring good, sound advice and wisdom to the table that is based around these time-tested core principles. These are things that don't change and they don't go out of favor based on anything, really. It's not about who's the president or, is the sky falling. Hopefully you found that as well in your relationship with us, that we bring a sense of peace and order to the table, and we make decisions for you and your family based on core principles. And I'll go over some of them. This isn't an exhaustive list, but I thought that this would be important to talk through. So number one, time in the market versus timing the market. Have you ever tried to catch a falling knife in the kitchen? Sometimes you get cut. So where it comes to markets, we already built it into your financial plan that markets will go down 2 years out of every decade. It's not a matter of if, it is simply when. We don't know when, but we always know that they do go down, and it's 2 years out of 10. So 8 years of positive results, 2 years of negative results. And just like if you were to go out in a rain shower, you'd wear a raincoat. You wouldn't just not do or not live life in that sense. So time in the market. Keep your short-term money in short-term accounts like checking and savings. Your longer-term future money, keep it invested. Which brings me to number two, long-term perspective. Don't make short-term decisions with long-term money and vice versa. Don't make long-term decisions with short-term money. You want to keep these in separate buckets, if you will, for lack of a better word, separate accounts, and you don't want to commingle those. Number three, diversify. So all of us probably heard from our grandparents, don't put all of your eggs in one basket. Now you can have one financial advisor and have multiple baskets. And even better, you can hire a team of professionals like us at Atlantic Wealth and still be diversified in your asset holdings. So you should own some real estate. You should own some stocks. You should own some CDs. You should own some bonds. Those work out well over time, having a diversified portfolio. And it's more important about where your assets are allocated. Asset allocation becomes critical in these times because you don't want to load up on any one sector or try to guess what is going to be the best next hot stock. Rather, wouldn't you be well served, and time has shown this, to have a lot of different assets. And then the next one is regular rebalancing, which we do. And so we take a forward-looking view of the markets and the capital market assumptions including what the Fed is doing, and other economic data. And then we make a decision based on your specific situation, and then we recommend reallocating. So this is the example of selling high and buying low. So if you've done really well in a certain asset category, you would want to trim off some of those gains and reposition them to things that have not done so well. And then lastly, we want to buy good quality. So sometimes having good quality still means that you have a price reduction in a recession. That's not a bad thing. It's just simply what somebody is willing to pay you. Mr. Market is going to pay you less for a good quality asset in a bad time period. That's not an example of why you should exit those good quality positions. And that helps a lot when those time periods do come. As we've told you in meetings before, the 2 negative years and the 8 positive years is very similar to the farmer who doesn't have a rain shower, or there's a drought, even worse, there's a drought and crops don't grow. That farmer does not put the for sale sign on the 40 acres. Rather, if he has the cash, he would buy his neighbor's 40 acres. And then when it does rain again and the crops grow, there's a greater yield. So we all understand that concept. And so we want to practice that through these time-tested investment principles.
Absolutely. A few things I want to share from a financial planning news standpoint. A big one is Social Security Administration. They announced a 2.5% increase COLA, so that's the cost of living adjustment. For those that are receiving Social Security payments, that's going to begin in January 2025. My understanding is that Social Security Administration is going to start sending out those notices. They've announced it, but then they're going to start sending out the notices towards the end of the year. Another point from Social Security is if you are still working and you're paying Social Security tax, part of that FICA, that the earnings limit has increased. This is again going to start in 2025, and that increase is now over $176,000. And so you would pay that Social Security tax up to that amount if you're still working. For the earnings limit, we sometimes get the question about that. Okay, if I start drawing Social Security and I'm, maybe working part-time or still working, I'm not yet what's deemed as full retirement age from a Social Security standpoint, how does that affect my payments? And that's where the earnings limit comes into play. So if you're younger than your dedicated full retirement age, and so for most people, that's generally between somewhere in that 66, maybe 10 months, 67, that earnings limit is actually increasing to $23,400. Again, remember, if you're younger than that full retirement age. If you retire in the year in which you turn full retirement age, they've actually increased that earnings limit for that for 2025 to $62,160. If you're full retirement age, keep in mind that there is no earnings limit, so you can make whatever you want, and there is no deduction for that.
So you can make as much as you want after full retirement age?
Yes, full retirement age. So there's no limit on earnings for workers after that time. Yep.
Is there a one-size-fits-all on when to take Social Security income?
No. Not at all. It's a very individual approach, and we take into account, if you're still working. We also take into account those that are married and have a spouse, especially if we have a spouse that is either much older or much younger. So definitely not a one-size-fits-all.
Excellent. Thank you.
Tara. If you have been on one of these webinars with us before, you know that we always kind of wrap up with some biblical wisdom. And speaking of wisdom, these couple of verses from James 1:5-6 read, "If any of you lacks wisdom, let him ask God, who gives generously to all without reproach, and it will be given him. But let him ask in faith with no doubting, for the one who doubts is like a wave of the sea that is driven and tossed by the wind." And I love these couple verses. There's a lot of places that we can look to for wisdom today, but there's really one source of true wisdom that we can come to confidently, and that is our Heavenly Father. And outside of that, we're more apt to feel like the last part of those couple verses, like a wave of the sea that's driven and tossed about by the wind, or the news of the day, or fill in the blank with any number of different things. And so just wanted to remind everyone of that, encourage you with it, and just offer up that we'd be happy to talk to you further about that if any of you have any additional questions, but be encouraged by that. And that brings us just to the conclusion of our presentation today. We want to just say thank you to all of you for joining us. We thank Marilyn again for being a part. And if any of you would like to reach out further to her, we put our information up earlier on the screen, but you could also reach out directly to us and we can get you in touch with her. We are here to serve and to be a resource. So if you have questions about anything that we have talked about or mentioned, or if you think there may be family, loved ones, neighbors, coworkers that might benefit from a conversation with us, please let us know. We do enjoy helping folks. That's what we're here to do. And so we welcome the opportunity to continue to do that with more and more folks. And so with that, anything else, Greg?
I think it's important to share that this is a resource that you could use. We usually have these posted to our website within a couple of weeks after compliance reviews and approves them. So if that is the case, you can certainly forward this to somebody you care about, and maybe it's beneficial for them, as Jay said.
Awesome. Well, we will wrap up our time together till next time, and I hope everybody has a good next few weeks, a great Thanksgiving holiday, and we'll see you soon.
Our next webinar is January 27th, so mark it on your calendars. We look forward to seeing you then.
Don't want to miss it.
It's a wrap.
Bye.
All right.
Thank
See you
you.
guys.